Many foreign entrepreneurs assume that once they incorporate a Hong Kong offshore company, they automatically qualify for offshore tax exemption. The reality, you have to apply for it. Prove that your profits truly come from offshore activities and meet strict ongoing requirements. But here's the opportunity. If you structure things correctly and maintain proper documentation, you could legally pay zero tax on profits earned outside Hong Kong. Hi, I'm Vincent from Statrys. Today, I'll walk you through exactly how Hong Kong's offshore tax exemption works, what it takes to qualify, and how to structure your operations to maximize your chances of approval. Let's dive in. Let's start with the basics. What exactly is offshore tax exemption in Hong Kong? Hong Kong operates on a territorial tax system. This means only profits generated from activities within Hong Kong are subject to profit tax. Profits earned from genuine business activities outside Hong Kong can qualify for complete tax exemption. So if your Hong Kong company earns profits entirely from overseas operations, you could legally pay 0% tax on those profits. But here's the key word: qualify. The Inland Revenue Department, or IRD, doesn't just take your word for it. You need to prove that your business activities genuinely happen outside Hong Kong's borders. This is especially valuable for businesses that operate globally. Consultants serving international clients, trading companies sourcing from one country and selling to another, or service providers delivering work entirely overseas. Now let's talk about who actually qualifies for offshore tax exemption in Hong Kong. To qualify, there are two core conditions that must be met. First, your business must be legally registered in Hong Kong. This includes limited companies, sole proprietorships, partnerships, and even branches of foreign companies. Without Hong Kong registration, you're not eligible to apply. Second, like we've already mentioned, your profits must be generated entirely outside Hong Kong. The profits you want to exempt must come from business activities carried out overseas. It's not enough to simply have overseas clients. The actual activities that earn the profits must also happen offshore. So what does the IRD really look at? They look at where your profits are generated. If your core business activities, things like negotiating deals, signing contracts, or delivering services, take place outside Hong Kong, your profits could qualify as offshore. But if those activities happen in Hong Kong, the IRD will treat the profits as Hong Kong sourced and fully taxable. Let me give you two quick examples. Example 1. Your Hong Kong company sells products to customers in Australia. The goods are stored in China, shipped from China, and contracts are signed in Australia. In this case, your profits may qualify for offshore exemption. Example 2. Same business, but this time the goods are shipped from warehouses in Hong Kong and contracts are signed in your Hong Kong office. Here, the IRD would classify the profits as Hong Kong sourced, meaning you'd pay full corporate tax. If your business meets both conditions, you'll need to file an offshore tax claim with the Inland Revenue Department. The IRD will then review your case in detail and decide whether your profits truly qualify as offshore. But before you file anything with the IRD, let's take a step back and walk through an overview of the steps involved to obtain offshore tax status. Step 1, and most obvious, you'll need to incorporate your business in Hong Kong. You also need to obtain a business registration certificate from the Inland Revenue Department to prove your registration as a Hong Kong taxpayer. If you're registering a new business, here's what you typically need: a unique company name, at least one director who can be a Hong Kong resident or non-resident, minimum $1 in share capital, your articles of association, the incorporation form, and the local company secretary. We have separate videos that cover this in detail, which you'll find linked in the description below. Once your company is incorporated, you're ready for step 2, proving that your profits are truly offshore. As we covered earlier, the Inland Revenue Department will assess this based on where your profits are actually generated. To qualify your business, you should have no physical office, employees, clients, warehousing, or fulfillment activities in Hong Kong. The IRD applies clear principles to determine the source of profits. Here's what they focus on. First, where your core business activities take place. For example, if you're sourcing products from China and selling to customers in Europe, and none of the transactions happen in Hong Kong, your profits may qualify as offshore. Second, where transactions are executed. The IRD looks closely at where deals are negotiated and where services or goods are delivered. If you're providing consulting services and both the negotiation and delivery happen outside Hong Kong, the profits may still qualify. Now, here's what could hurt your claim. Signing important contracts while physically in Hong Kong, negotiating major deals from within the city, delivering services on Hong Kong soil, or relying on vague explanations without proof. Straighten your case. Keep all profits generated activities offshore. Sign contracts, deliver services, and store or ship goods from outside Hong Kong. And document everything. Contracts, invoices, travel records. Because that's exactly what the IRD will review. Finally, having an overseas presence makes your claim stronger. Without offices or operations abroad, profits are usually taxed in Hong Kong. Now, the final step is to prepare your documentation and submit your application. To support your offshore tax claim, you need to show clear evidence to the IRD that your profits are derived entirely outside of Hong Kong. Proper documentation isn't optional. It's essential for approval. Here's what you need to gather. Basic company information, company addresses for headquarters and any affiliated offices, both inside and outside Hong Kong. Your organizational chart showing company structure and management hierarchy. Core documents like Certificate of Incorporation, Article of Association, shareholder agreements, and, if relevant, details about parent group companies. Business and operations records, contracts and agreements that prove negotiation and execution happen outside Hong Kong. Financial records like invoices and bank statements that are consistent with offshore activities. Email correspondence that shows where key business decisions were made. Outsourcing documentation explaining how third-party activities are monitored. Economic substance records such as employee details, office leases, and operational expenses abroad. Now you're ready to claim offshore tax exemption in Hong Kong. Here's what the timeline and process looks like. You'll file your offshore tax claim with your first profits tax return, which is due 18 months after incorporation. The IRD will then review your documents thoroughly, and this examination can take more than 6 months. Once submitted, stay proactive. Respond quickly to any inquiries and provide extra information without delay. Smooth communication makes a big difference in processing. If approved, the IRD will issue a letter of offshore tax exemption. This status usually lasts 3 to 5 years. To keep it, you'll need annual audits that confirm your business activities remain offshore. What should you do if your application gets rejected? First, carefully review the common reasons offshore tax exemption claims are denied. These often include having staff or operations in Hong Kong while claiming offshore status, conducting sales or signing contracts in Hong Kong, failing to provide strong evidence of offshore transactions. In many cases, you need to submit additional documents or clarify details from your original application to address the IRD's concerns. Seeking professional advice from a company secretary or a tax consultant can provide valuable guidance and increase your chances of a successful claim. So there you have it, your complete overview of Hong Kong's offshore tax exemption. Remember, it's not automatic, but with proper structuring and documentation, you could legally pay zero tax on profits generated outside of Hong Kong. Here's your action plan. If you're setting up a new Hong Kong company, build offshore compliance into your planning from day one. Structure your operations genuinely outside Hong Kong's borders. Keep detailed records of where business activities take place, and work with professionals who understand offshore tax requirements. The key takeaway? Offshore tax exemption is a legitimate opportunity, but it requires genuine offshore substance and meticulous documentation. If you'd like more useful information on Hong Kong companies, hit that subscribe button and see our Hong Kong business guide, which we've linked in the description below. At Statrys, we help foreign entrepreneurs with our full suite of services that covers incorporating Hong Kong companies, setting up business accounts, and ongoing compliance. Have questions? Reach out via live chat, WhatsApp, or email us at support@statrys.com. Thanks for watching.